The key to finding great stocks is understanding a company's products, not just their profits. Huge growth happens when a company makes the perfect product for a new or quickly growing market. Tesla made investors rich by conquering the growing electric vehicle market, and nvidia made millionaires by building the data center chips behind the generative AI revolution. And in this episode, I'll highlight a few stocks set to win big in the AI era, making them a great foundation for small portfolios. Your time is valuable, so let's get right into it. First things first, I'm not here to waste your time, so here's what I'll cover in this video. I'll start with a couple funds that set a solid foundation for any small portfolio. I'll highlight a few mega cap companies with great platforms, products, and services, as well as some smaller AI companies with plenty of room to grow. And then I'll share a few tips specifically aimed at growing smaller portfolios over time. But let me point out three quick things before diving in. First, this isn't the ultimate stock list. Think of it as a solid foundation specifically for small portfolios in 2024 and beyond. If you want to buy more great companies like Tesla down the road, you can always add them in later. But I picked the stocks in this video because they all work together. Second, I'm not a financial advisor. My background is in electrical engineering and data science, and I have about 10 years of industry experience using AI to solve real-world problems. That's why every stock I cover focuses on AI, and I share my investments for educational purposes only. And third, there's a lot of ground to cover, so I'll be keeping things pretty high level. This entire channel focuses on the science behind the stocks. So if there's a company that interests you, you can probably find a video where I cover it in way more detail. With all that out of the way, let's get right into the investing. In my opinion, one or two funds make a great foundation for any long-term portfolio, even small ones. When I first started investing, the advice I always heard was to put some money into the market every month, which means buying the S&P 500. The S&P 500 tracks the 500 largest public US companies weighted by their market cap. That means the bigger the company, the more of its stock is in this index. There's actually a lot to like about the S&P 500. First off, it's up by around 19% year to date, which is an amazing 7-month return when you consider how diversified it is. Funds that track the S&P 500 also have very low fees. For example, the expense ratio for SPY is just 0.0945%, which means for every $10,000 you invest, you'd only pay $9.45 in fees each year. That's not bad, but the S&P has a few challenges for small portfolios. 500 companies is a lot, so this fund grows much slower than its own biggest holdings. Its top 5 companies right now are Microsoft, Apple, nvidia, Amazon, and Meta Platforms. Amazon is up by 30%, Meta Platforms is up by 45%, and nvidia is up by almost 170% so far this year. But the S&P 500 is up by much less, since the other 490 or so companies have been performing much worse on average. So one of the best things for smaller portfolios is to hold fewer stocks. That way, a winner can provide meaningful returns. Fewer stocks means more volatility, but that's a good thing for long-term investors since higher highs mean better returns and lower lows mean bigger discounts on the stocks you're already buying anyway. So the first fund I'd consider for small portfolios is the NASDAQ 100, which tracks the 100 largest non-financial companies listed on the NASDAQ stock exchange. Since this fund doesn't hold financial companies like commercial banks, it gets filled with more tech-focused companies benefiting from this huge AI boom. The top 5 holdings in the NASDAQ are exactly the same as the S&P 500: Apple, Microsoft, nvidia, Amazon, and Meta Platforms. But since it only holds 100 companies, each one gets more weight, which means the index can make bigger moves. For example, while the S&P 500 grew by a whopping 26% in 2023, the NASDAQ 100 crushed it, growing by 54% that same year. That's more than twice the returns during one of the best years in stock market history. In fact, the NASDAQ has outperformed the S&P in 12 of the last 15 years, making a great way to reliably beat the market without getting lucky. There are 2 options when it comes to buying this fund: QQQ or QQQM. In a nutshell, long-term buy and hold investors should go with QQQM because it has lower fees, while bigger portfolios that use indexes as cash should consider QQQ since it has a much smaller spread. The more times you plan on buying and selling this fund, the more you should consider QQQ. For smaller portfolios, consider starting with QQQM. The next fund I want to highlight is actually one of the best performing ETFs of all time, and it's filled with the exact same stocks I always cover on this channel. I get asked all the time how I make these videos, and I won't lie, it takes a lot of organization. From the research and writing, to editing, scheduling, and performance tracking, there's a lot to stay on top of, just like with any business, side hustle, or personal project. That's why I'm so excited to tell you about ClickUp, the sponsor of this video. ClickUp is the ultimate one-stop shop for personal and professional productivity. It's super easy to create folders and pages for all your projects, drag and drop text boxes, task lists, and attachments. Or if you're lazy, efficient like me, ClickUp has over 1,500 pre-made templates for all kinds of projects. Then, with the push of a button, you can zoom out and see the status of every task, its dependencies, and when it's due. And if you manage a team like I do, you can even collaborate with partners, manage calendars, and track time on individual tasks, which used to take me at least 5 different apps to accomplish. It's crazy how much time and energy gets saved when everything is all in one place. But here's the best part. You can try ClickUp for free by going to tryclickup.co/ticker, or just use my link in the description. And a big thank you to ClickUp and to you for supporting the channel. Alright, the other fund that can really grow small portfolios is the VanEck Semiconductor ETF, ticker symbol SMH, which tracks the largest chip companies listed on major US exchanges. I really like this ETF for a few key reasons. First, it only tracks 25 companies, which means it's very concentrated. Its top 5 companies are nvidia, Taiwan Semiconductor, Broadcom, AMD, and ASML, and together they make up 51% of this fund, with nvidia having around a 20% weighting all on its own. Remember, fewer stocks means more volatility, which is a good thing for small portfolios that we're actively contributing to. And while the fees for SMH are 0.35% per year, it's returned 64% year to date, 73% over the last 1 year, and a whopping 375% over the last 5 years. In fact, SMH has a long history of high performance. If you invested just $1,000 when it was created at the end of 2011, you'd have over $22,000 today. And the next few years look just as good for semiconductors, since the global AI chip market is expected to more than 11x in size over the next 9 years, which is a compound annual growth rate of over 31% through 2033. That makes SMH a great fund to help grow smaller portfolios without getting lucky. I'm spending a lot of time on the funds because investors with smaller portfolios shouldn't focus on trying to pick stocks. They should build momentum by letting their money compound over time. And the best way to do that is dollar cost averaging, which is where you invest the same amount of money every week or month or quarter. Not shares, but dollars. The great thing about DCA is you end up buying more shares for the same amount of money when prices are low, and fewer shares when prices are high, so the math is always in your favor. I'll drop a link to a great article titled "Even God Couldn't Beat Dollar Cost Averaging," which compares the returns from dollar cost averaging to buying the exact bottom of every single dip, which obviously would require godlike timing. And DCA still wins, since you get more of your money into the market earlier, and the market tends to get more expensive over time. That makes dollar cost averaging into high-performing funds a great way to get rich without getting lucky. Then, as your small portfolio grows, it makes sense to start adding individual stocks, but they shouldn't be random stocks you heard about from a friend or from someone on YouTube. In fact, some of the best stocks are the ones that everyone already knows about, like the mega cap companies at the very top of the NASDAQ, companies like Apple, Microsoft, Amazon, Broadcom, Meta Platforms, Tesla, Nvidia, and Google, which together account for over 40% of the NASDAQ by weight. But if you're just getting started, how do you pick between these well-known tech giants? In my opinion, the best companies are the ones with platforms that other businesses pay to build on top of. For example, Microsoft, Google, and Amazon own a combined 2/3 of the global market for cloud services, and millions of businesses pay them each year to do things like store and secure their company's data, host mobile and web applications, use their computing clusters, and access a wide variety of AI and machine learning tools. These services run on top of massive global networks of data centers that are incredibly expensive to research, develop, deploy, maintain, and upgrade over time. And it would cost a business way more to build even a tiny fraction of these services for themselves, so these cloud providers won't be getting disrupted anytime soon, even by generative AI. And all three of these companies have massive software and hardware ecosystems that millions of businesses rely on and billions of consumers use every month, making them great picks for portfolios of all sizes. Alright, so far we've picked 2 funds that give our small portfolio a high chance of beating the market, and 3 tech giants that have a very wide range of services, products, and platforms used by millions of businesses and billions of consumers. These next few companies are smaller and more specialized, which makes them much more risky. So if you have a small portfolio, you shouldn't lock too much of your hard-earned money into these kinds of companies until you've really done your homework. And if you feel I've earned it, consider hitting the like button and subscribing to the channel. That really helps me out, and it lets me know to put out more content like this. Thanks, and with that out of the way, let's get into the smaller and more specialized stocks. First up, Palantir. Palantir makes AI-powered platforms that give huge enterprises a real-time view of their data to optimize their operations. Palantir's platforms are often used in high-risk and highly regulated markets like national security, heavy industries, medical, and international transport. Users can even send commands to assets under their control directly from Palantir's platforms. For example, a power company can monitor and rotate wind turbines, a logistics company can reroute their trucks, and a commander can task different military units in real time, which shows just how much some of the biggest governments and enterprises on the planet trust Palantir's platforms with their most sensitive data. Because of that, Palantir's solutions need to be incredibly accurate, fast, and secure, which is still a huge challenge for AI-based tools today. Another reason that I picked Palantir is because it's a very agile company, which is important because generative AI is evolving very quickly. For example, Palantir stood up their artificial intelligence platform, or AIP, just a few months after ChatGPT came out, and it's now their most demanded platform. Do not make the mistake of investing in any company without understanding what it does and who its target customers are. I have personal experience using Palantir Foundry, and I've made almost 20 videos over the last 3 years explaining Palantir's platforms. I'll leave a link to my Palantir playlist in the description below as well. The second specialized stock for small portfolios that I want to highlight is CrowdStrike. CrowdStrike is a cybersecurity company that focuses on endpoint detection and response. They have a cloud-based platform called Falcon to stop data breaches and respond to any attacks that do manage to get through. Falcon has 3 parts. First, they have different cloud-based modules to perform tasks like antivirus scans, manage firewalls, and hunt down different cyber threats and malware. Part 2 is their proprietary threat graph, which is a network map that tracks the connections between people, mobile devices, workstations, data centers, and pieces of cloud software in an organization. And the Falcon Agent is a tiny piece of software that runs on every device to capture data, send it back to CrowdStrike for monitoring and analysis, keep their threat graph up to date, and decide when to run the different cloud modules behind the scenes. CrowdStrike is the market leader in endpoint detection and response. Gartner ranks CrowdStrike above Microsoft, SentinelOne, Palo Alto Networks, and Fortinet in this area, all of which are great companies. And CrowdStrike stock has nearly tripled over the last year because they have the perfect products for securing data in these new and quickly growing AI markets. And as I said at the very start of this video, huge growth happens when a company has the perfect product for new or quickly growing markets. Well, the global cloud security market is expected to 6x over the next 8 years, which is a compound annual growth rate of 20% per year. Another market that's set to grow fast is the global edge computing market. It's expected to roughly 4x over the next 8 years, which would be an 18% compound annual growth rate. Edge AI, sometimes called on-device AI, is about to take off big time. At a high level, Edge AI is where laptops and phones are powerful enough to run AI models on the spot, instead of needing to send the work to servers in the cloud and wait for the results. That means that AI at the edge runs way faster, it's more secure, and it can work without the internet. For example, the Samsung Galaxy S24 Ultra has awesome AI features like Circle to Search, where you can circle something on your screen to either search or reverse image search it, or their Live Translate feature, which can automatically detect the language of both speakers and convert speech to text and text to speech between them, or their AI-enhanced camera, which combines optical and digital zooms for up to a whopping 100x zoom. Well, the Samsung Galaxy S24 Ultra is powered by Qualcomm's Snapdragon 8 Gen 3 processor, and the Meta Quest 3 is also powered by Qualcomm's 8th generation Snapdragon XR chips, which focus on using AI to enhance graphics, do advanced eye tracking, and gesture recognition to create more immersive and realistic mixed reality experiences. Even the Ray-Ban Meta smart glasses use Qualcomm's Snapdragon AR chips to enable real-time photo, audio, and video processing, as well as even streaming video inside this tiny form factor. Alright, now that we've covered a couple great funds, 3 high-performing tech giants, and 3 examples of smaller and more specialized companies, let me put it all together with a few quick tips for growing small portfolios. First and foremost, I would put at least half of my money in the 2 funds, starting with the NASDAQ 100 and using SMH to get more exposure to great chip stocks on top of that. Since stocks like nvidia and Broadcom are at the top of both funds, I get a lot of exposure to them without worrying about timing the market or spending too much on fees. I would put at least 30% of my money in one or more of the cloud service providers, Amazon, Microsoft, and Google. While almost all the big tech giants have been performing well, these 3 companies have so many consumer products, enterprise services, and solid revenue streams that they're basically portfolios themselves. If I could only choose one, it would be Microsoft, since Azure is already the second biggest cloud service provider, the fastest growing cloud service provider, and Microsoft owns 49% of OpenAI, and by extension, ChatGPT. But that's just my opinion, and I've been buying all 3. That leaves the last 20% for smaller, more specialized, and more speculative companies like Palantir, CrowdStrike, and Qualcomm. These are all companies with strong leadership positions in quickly growing markets, even over the tech giants that we talked about. But they're also very volatile, which means you should practice discipline, dollar cost average in, and make sure to understand the science behind these stocks. When it comes to growing a small portfolio, that's the best way to get rich without getting lucky. Thanks for watching, and until next time, this is Ticker Symbol U. My name is Alex, reminding you that the best investment you can make is in you.